Good evening and welcome to yet another edition of Moneycontrol Masterclass. I'm Chandra Ashrikant, and to discuss a very interesting topic today, we have four very interesting speakers. Madhukar Sinha of India Quotient will be joining us in a bit. He's joined us. We have Jitendra Gupta, the founder and CEO of Jupiter, Madhukar Sinha, managing partner at India Quotient. We also have Tarana Lalwani from Innoven Capital, as well as Sandeep Jethwani from Dezerv. What's the topic we are discussing today? After the crazy deal making and the frenzy that we saw in 2021, is the Indian startup party coming to an end? Are we in for a funding winter? That's what we're going to discuss. Are we, being too pessimistic? Not really, because based on anecdotes and indications from various people we've been talking to in the last few weeks, it looks like things are slowing down. In fact, I'm going to start with a tweet that I read recently. I think it was put up by Abhay Pandey, and he was quoting another investor. He said the party is over. All we are left with are tired legs and a nasty hangover. And as the makeup fades and alcohol recedes, the hot ones don't look as attractive. I'm not sure if all of you agree with him, but I'm going to start with Jiten. Jiten, give us a sense of the current mood in the startup ecosystem and contrast it with 2021. Because, you're not just an entrepreneur, you're also one of India's most active angels, investors. You're in touch with various startups, entrepreneurs across, cutting across sectors and businesses. So paint us a picture of what's happening right now.
Sure, Chandra. Thanks for inviting on the show, Chandra. So I'll just start with this saying that when you look at these sentiments which which evolve suddenly with one turn of event, I think personally I have seen three such cycles in last 11 years of my startup journey. And every time we enter into that sentiment, uh, we start believing that the world is getting over, rationality will come in forever. But to my surprise, we ended that rationality or rational behavior like within a couple of years or max 12 months. Or like, I mean, the 12, a couple of years, like a lot. In fact, I've seen in 12 months the rationality ending. So I must say yes, 2021 was a crazy year, definitely crazy year. We were seeing the rounds happening almost every 2 months. In fact, the next round was being negotiated before the first rounds or the previous rounds money was in the bank. So we have seen those kind of craziness. Uh, we have seen like what 50 plus unicorns last year. So that itself shows the kind of liquidity which was there in the system. Uh, yes, last 1 month we have seen rationality. Uh, that being said, I'm still an optimistic guy. Being an entrepreneur, because I think the bigger India story is still at play in terms of the internet ecosystem growing fast, the consumer habits evolving very, very fast. People have more net disposable income. So I think that story remains intact. Of course, the sentiments are on a lower side in last 30 days. Uh, but will these remain like this? I'm not sure. I think maybe 6 months or 12 months sentiments will remain like this. At least that's my hope. And post that, we are back to the party, I must say.
Back to the party. But
Maybe
Jitin, when
not
you
a
say
crazy. Sorry, go ahead.
yeah, no, Jitin, when you say rationality has kicked in, things have slowed down, can you give us an example of that? Because, we are hearing about some deals taking longer to close out. Some of these deals in the series B, C, D coming under pressure. So, can you give us some examples? How should we really gauge this when you say rationality has kicked in and things are slowing down?
Sure. So, Chandra, what's happening is if you look at like how this irrational behavior came in, I think while the India story was playing off well, but also the the booster was from the liquidity situation worldwide. So the Fed printing extra money, and the public market investors making like 2x, 2.5x return within a year, which is unprecedented if you look at it. And that generated a lot of liquidity to put in into the private market as well. Now, last 60 days, we have seen that most of the public market investors are back to the regular returns, or they have lost capital by 30% or 40%. And that is leading to drying up of capital even in the private market. And that brings to the question of that, let's say if I have a lemonade as an insurance company available at $1.3 billion, why would I invest in a market where there is a company who's asking $2 billion with revenues which are one tenth of lemonade? Similarly, like Robinhood, if you look at it, down by almost 75 or 80%. So why would any investor would invest in an alternate market in the company which has one tenth of revenue or one fifth of revenues at a similar price range? So I think that is what I would call rationality kicking in from a investor standpoint.
Madhukar, would you agree with that? That rationality is kicking in, and it's not as euphoric as what we saw in 2021. Because in 2021, we were hearing about 5 minute pitches, and deals getting closed in 1 day, 2 days. VCs working over weekends because they were worried that founders had like 4, 5 term sheets, so they had to crack the deal at any cost. In fact, the same time last year we did a story on VCs saying that we're really scared that we're going to end up doing something stupid because there was just so much of competition at that point to get that hot deal. What are you seeing currently?
Yes, Chandra, thanks for inviting on the show. First of all, uh, I don't know which VCs are so busy working weekends to do the deals. Most VCs are not that busy. At least I am not that busy, right? Having said that,
No,
right?
I was saying last year. This
Last
year, I
year.
don't know. You should tell
No,
me
Hey,
this
I
time.
don't know the way, but
I'm
Madhukar,
saying all the time, right? So VCs, what do we do? Why will we be busy, right? So most of the work is being done by the startups, thanks to people like Jiten, right? They are the ones who are doing the work on the ground. I think having said that, uh, I would say that the deal making is still happening at a frantic pace. It has not slowed down as of yet, right? So I think there is a lot of noise that it is slowing down, but I think there are still a lot of deals happening. What has happened in the last 45, 60 days is that now the companies which have raised a lot of capital and which were expecting to go to the market again to raise capital, they are being questioned on their uh, business, right? So people are asking that basis what you are going to go to the market again, and the market might not entertain you. So you have to start looking at unit economics. You have to start looking at your retention cohorts, right? And some of the other things which were largely being hidden by growth, right? Now everyone is lifting up that veil and trying to peep inside and try to figure out what is the real health of the company, right? And that is kind of creating some concern. And most of the startups or the high growing ones which were raising money every 3 months, now they are being asked some hard questions. And those questions, they are feeling that why are we getting asked this question, because 6 months back nobody was asking this question, right? I think that's broadly what I can see in the market. That there are still so many deals happening, right? So you every day you wake up on Twitter, you see somebody raise 80 million, somebody raise 60 million, right? So I think the deal making is still there. Uh, but yeah, some rationality is kicking in, and I think we'll start to see the effect of that in the coming quarters.
But one doubt that I had, we are still reporting deals every day. But some people also say that these are deals that were done maybe in November, December, or they were closed by Jan. But the effect of the slowing down now will only be visible in April, May, June. But you're saying that still hasn't happened. That it is
No,
as frenetic as before.
I think there is some lag, of course, but I think when the market will really become rational, right, then some of these deals will start getting renegotiated, some of these deals will not go through, and all those things will also happen, right? Which has not started yet, right? So I think right now, maybe we are at the end of that cycle, right? Maybe we are just about at the end, right? Having said that, Chandra, one thing is also important to understand, that this this sentiment driven change will largely affect either heavily funded startups or startups which are at the late stage, right? At the early stage, there is a lot of capital which has been raised by VCs, right? And these are uh, not drop-in investors who come from US and invest in India, right? So there are all the VCs, including us, right? So we have also raised fund this year, and Excel has raised, and Sequoia has raised, and SAF has raised, and so many people have raised so much of capital, right? So, and therefore the deployment at early to mid stage, I think till Series B, uh, will remain at the same pace. Maybe a couple of quarters of little bit of slowdown, but I don't see much of a change coming at that level, right? So I think there will be a lot of deal which will happen in this year also, and that's largely driven by liquidity, as Ethan had pointed out, because a lot of LPs also got a lot of distributions, right? And that distribution they had to park somewhere, right? So therefore, the cycles of fund raise, even in US, people who used to raise every fund every 3 years, they were raising funds every 18 months, right? So so all of that is has to be factored in. So at late stage there will be some amount of stress and pressure, but I think uh, we are good. We're not really. We don't need to call this winter. It's definitely not going to be like 2016, right? So
Yeah.
Right, that's heartening to hear. Tarana, would you agree with that? Because, I mean, if you see some of the commentary, right? I mean, Tiger Global has been talking about it. SoftBank's Rajiv Mishra had some very strong comments on this. He
Nice.
said,
Yeah.
it's high
Yeah.
time that
Yeah.
valuations are rebalanced. And even if you look at what Shailendra Singh said, right? He
Yeah.
said, we welcome a correction. Though Sequoia sort of led the pack when it came to funding last year. So, what is your sense? Because 2021 was also a banner year for venture debt.
Exactly. So I think, to be honest, I think it's all relative, right? So let's take a step back. 2021 was an exceptional year. I mean, I think if 2021 or starting after the COVID lockdown, if the euphoria, and I mean, Abhay called it a party. I'd say it was a rave. It wasn't even a party. So I think one, we have to look at relatively. Two, I think a lot of things have changed in the market from the last downturns that we saw. So personally, I don't think it's a winter. I echo Jitendra and Madhukar's viewpoint that I think we will see a slowdown. We'll see some rationality come in, and that's actually not a bad thing. That's actually, I think, a positive, because I know Sandeep and Jitendra don't want to hear this as founders, but I think we need to see some discipline come into the market, right? From a DD perspective, from a diligence perspective, and like Madhukar said, I mean, we need to start focusing. Do these business models make sense? Um, and I think also what's happened, the market's matured, right? So we, as Madhukar said, we do have a lot of dry powder with the funds, but what we're forgetting on the early stage side, we also have a lot more angel investors, right? From within the ecosystem, founders, they're second, third time founders. They are now active angel investors. So we're seeing that sort of early stage momentum also come in, where, and these founders, most of them being from the ecosystem, understand that there's a cycle to these companies. So I think we're seeing some sort of, because of the maturity in the market, we may not see the down, I want to say an extreme downturn or a winter. If I had to classify it, I'd say more like a fall, where there's rationality coming in, to Madhukar and Jitendra's point, and I actually think that's a positive. As I said, they may not agree, but I think, like they said, every 3 months seeing a valuation uptake based on no real model, nothing, didn't make sense, was not justified, right? I mean, now actually, people will actually have to explain their models. I think we'll still see a stifting, where good companies, to Madhukar and Jitendra's point, I think late stage good companies will still get the funding they deserve. So if you've proven your model, or if you're a SaaS business and you're over that 10 million ARR, you've had your product market fit, I think good companies will still get funded in the growth and late stage. Yes, maybe valuations from public relative to public markets, we'll benchmark and we'll be a little more cautious on that. Early to growth, I think we'll see a momentum that will continue at least in my opinion. I could be wrong, but I believe it's and overall, if you look at it from a, because like I think Jitendra, I think, said there is a lot of there was a lot of capital, there still is a lot of capital in the market, right? Especially at early stage. So I mean, if I look at it as just macro,
Hmm.
considering where am I going to park my money to some extent, right? If with inflation, would I rather invest it and have it grow, or just keep it earning zero and losing money? So I think that's sort of the trade-off. Also, we'll have to figure out and see where we go. But
Right. Right. Sandeep,
personally,
you want to respond to what Tarana said on the founders part, and maybe Jitin can also, respond
can
to
I hide my face and run away?
Yeah,
that.
it's
Founders have to be more disciplined, and maybe they will
I
have to
think
start.
Madhukar also said it. Yeah, not only me. Madhukar also
Okay,
said it
okay, okay.
in a
She's
way.
hedging. She's hedging herself.
Thanks,
Yeah.
Chandra, for having me, and thanks for putting both Jitin and me in a spot. But to be honest, I think if you look at it from an overall markets perspective, look, I think interest rates are rising. It is possible that you will see less liquidity available than there was earlier available. So I think, what does that mean? That means that investors will take a little more time to do those transactions, which they would have earlier done much faster. So in terms of deal closures, will they take more time? Probably they will. I think the true sort of takeaway from all of this is that the bar for quality is rising. More questions will get asked. The quality of founders that will get funded will be driven by the quality of work and delivery. So I think for me, I think the big change that potentially the next few months might bring, because at the end of the day, a certain amount of capital has been raised, has been committed to Indian startup ecosystems that will find its way into the market. Which founders and which companies it finds its way into, as both Madhukar and Tarana alluded, it will be driven by the actual performance and quality. Uh, and I think this question will be much more acute in the later stage as opposed to the earlier stage. In the earlier stage, especially right up to Series B, the quantum of capital that has been raised for India, and Madhukar may have a better sense of this, is close to $8-9 billion. And in the context of the size of the deals that is happening, that is very, very large. So from a investor perspective, they will deploy this capital. Early stage, I don't see much changing. But in the later stage, maybe more questions will be asked, and high quality founders will continue to get funded.
Right. Jitin, last year Jupiter, I think, raised two rounds of funding in a year. And, I mean, your valuation went up 2.5 times within months. And I think now you're valued at over 700 million. And there's also buzz that you'll be valued at 1 billion soon. But do you think it will be easy for you to raise money at the same pace this year? Because this valuation markup every few months, we saw this happening in multiple companies and even unicorns. I think Cred raised multiple rounds, Misho, infra market, and so on. Do you think that will still happen this year, or has the tide sort of changed or turned?
So that's an interesting question, and I would answer it slightly differently. So I would say at Jupiter, the way we have been operating it is that let's sort of not confuse spending and raising. Now, what that means is we raised when there was a opportunity to raise at a right price, but in terms of our spends plan, in terms of our burn and all of that, we remain very, very rational as if we had not raised the money. So you would be surprised to know, but we still have not consumed our Series A money, which we raised in 2019. So we have been that frugal in that sense. So I think it is also on the entrepreneur how they see these events of raising, and whether they get extra buoyant about raising money and then start splurging money accordingly. But yeah, we knew that these situations of liquidity don't remain forever. So from that standpoint, let's not inculcate any bad habits into our day-to-day operating style. So yeah, I'm not sure whether we would wanting to raise another round anytime this year. That being said, if there is a right partner, right investor, a right price, we won't even say no for that moment. So I think, but from a capital liquidity standpoint, like fairly well capitalized for next 5 years as well.
But are you still getting, a lot of queries from investors, something you perhaps got last year, or are you seeing more caution? People are, asking more questions.
So yes, we do see enough investor interest who are like generally curious about what's happening in Indian financial services space, what's happening in neobanking space, and I think all said and done, we have been growing well, or this sector also has been doing very very well. So there is a curiosity, considering there are examples like New Bank and other neobanks in the process of listing have been doing well. So definitely, this is one sector where there's a lot of interest. So we do see uh, similar interest, honestly, right now as well. But yeah, the investors also do ask in terms of the revenue models, in terms of the how the scale up is going to happen over next couple of years. They started asking profitability kind of questions. So which is real, and I think it's a honestly it is a math, right? So like when you I've been in investment banking and I've been on the investing side. So the generally the way these investors do their math is that if the interest rates are going up, their risk-free rate plus the cost of capital goes high. So effectively, they have to discount the future cash flows with that cost of capital, which is the adjusted risk rate. And automatically, if the adjusted risk rate, let's say, moves from 5% to 8%, there is a significant difference in the valuation, right? So it's a very natural for anyone to readjust the expectations from an investor standpoint.
Right, right. Madhukar, if you have to ascribe one or two reasons why this caution has sort of crept in, is it just the US Fed, or are there other factors playing on investors' minds? Because, in the last few months, we've also seen a wider sell off when it comes to new age tech stocks, not just in the US and Europe, but also in India. Stocks that listed with a lot of fanfare last year. So, what exactly is playing on investors' minds at this point? Is it just the taper tantrum, or other geopolitical reasons as well?
Yeah, I think most of the effect is because of macro reasons. I think the companies are the same, right? They were they are doing well. I think there's a lot of adoption, which we are seeing in the consumer internet and other software players in India. So I think there's nothing to worry about on the business front. Everything, frankly, was extremely high valued last year, right? So right from the public markets to the private markets, and I think when the public markets in the US have taken a hit, I think that is what is coming downstream, and that is why the correction is happening everywhere. But frankly, we don't see that the performance is dipping, right? So the market this time, at least the adoption in the market has been real, right? So it's not in 2015. Most of the companies which raised a lot of capital, those are mostly concepts, right? There were hardly any users, right? So very few users or very little unit economics. This year also a little bit of better unit economics would have been better, but still we have a lot of adoption, right? So companies are actually having millions of users, and as Jiten said, right, the financial services has seen a lot of adoption. We keep hearing the numbers of UPI, right? So it has been going up and up, up and up. So I think all the everything is fine. It was just we were overvalued. Now it is correcting, right? And for some, the correction will be more sharper, right? For some, it will be not that sharp, and some of the better ones might actually do better from here also, right? So I think that's how it will play out. But there is no other reason. So it is nothing it's not that the Indian market has performed stopped performing, right? So the companies are still growing, right? So we are seeing that in our portfolio also. We are seeing that the the growth is there, right? The companies are growing at similar rates. Of course, there was a dip in January because of Omicron, because half of the teams of most of the companies were sick and the consumers were also sick. So therefore, there was a dip. But otherwise, the growth has been good, right? So there's nothing to worry on the growth side. I think large part of the sentiment is coming from the macro reasons. One, the valuation of the public market stocks in US has dropped significantly. On an average, it is down in the range of 50% now. Some of them are down 80%. Some of them, so that is hurting. And of course, the war has also created some amount of uncertainty. So people are getting more and more cautious about it.
Right. Tarana, I take Madhukar's point that, this is largely on account of macro factors in US Fed. But, we have seen isolated events in the last, 2 months that could impact sentiment in a way. And this has to do with governance as well as business. So if you look at the way the Bharat Pay controversy has panned out, the fact that, there was some kind of a fraud, will that put off foreign investors, considering there were foreign investors on their cap table? Plus, you're also seeing spots of stress in select companies. An edtech called Lido Learning shut down. Yesterday, we reported that Blinkit is cash strapped and it's now looking for a lifeline from Zomato. In fact, we also reported that Innoven Capital extended some venture debt to them
Yes.
last month. You can confirm it if you want. But we are seeing these isolated pockets of stress. So, is there something more to it? The fact that the
So,
easy money is not available anymore, which is why some of these weaker companies are kind of showing signs of stress now.
so one, I mean, well, I mean, I'm going to rephrase and first take a step back. Now we don't know weaker or not weaker. Some may be weak, some may not be weak.
Yeah, I mean, not
In the
weaker, but
companies. So,
companies perhaps that
yeah.
were not
No, so
executing
obviously,
so
so I think
well.
yeah, no, no, fair enough. But my first, when you ask me my first question, I think rationality coming in is a good thing, right? I mean, from a DD governance point of view, yes, I think, what we saw in Bharat Pay is unfortunate. And it may impact a little bit on the Indian ecosystem, but let's also be honest, and I'm going to be a little patriotic here, and not patriotic, but just rationally. The same things happen. This has happened in the US as well, right? There was WeWork, Uber, the founders were brash. They were a little they were irresponsible. I mean, Elizabeth Holmes was a complete fraud. I mean, I'm not trying to defend Ashneer, but I mean, I think she's the worst of the lot, right? Um, so I personally think these are more, again, if you look at it from Madhukar's point, this, from a model perspective, it just brings in a little more DD and puts a little more onus on investors to start doing a little more work before they come in, which, to the point of rationality. Lido was unfortunate. I don't know much about that one. I can't comment on that one. On Blinkit, I think the news was half and half, to be honest. But that's fine. No comment.
No, you can
Um,
give us the full story. We will, update our story. If you thought it was half and half.
I think they're fine. I wouldn't put it as that coming to the rescue. I think, in, and I don't want to talk because I'm not Blinkit, and I have to watch what I say. But I personally think that we have to also understand some of these businesses are high growing businesses. Some things take longer than others, but let's be fair that the chances are that it's not. I wouldn't have titled it as a rescue. That's all. And say that, could we see some holes sometimes, I mean, there's just timing issues, right? You may be we all sort of sometimes just need to sort of manage time. I'll leave it at that. But in our opinion, the company is doing fine. So I'm an outsider. That's all I can say for now, that I believe they're doing fine. And as you know, in the venture debt model, you know we won't come into companies if there's an issue. You should, I mean, that's the criticism of the venture debt model, right? We're not a bridge loan.
Right.
So I'll leave
Okay.
it at that.
Okay.
But
So,
personally, I think, yeah, I do think that it would this may create a little more discipline in everyone. So I think we should look at the bright side of it. I don't know if Jitendra and Sandeep will agree with me. I think they would, because I know I was talking to two founders in Bangalore 2 weeks ago, and they themselves admitted that they rather have investors coming in doing a little more DD, right? And if you are, it's like if you're a smart, I mean, if you are a capable founder and you know your business model has legs, you rather have, and I'm going to take another side, you rather have your company get funded, quality companies get funded, than have companies that probably don't deserve to get funded. So if anything, I think this will be a good sort of I think Madhukar brought up this point that, we will see more the right companies with the high quality founders and valid business models get the funding they deserve. So I think it will be more of a sifting where the good guys will still continue to win. That's my 2 cents.
Yeah, interesting. In an environment where even Tata Digital is struggling to raise money, I don't know what's going to happen to.
Again, you have to, I think it comes down to sustainable model, right? Chandra, like it's not only about, like, I mean, no one's saying maybe their model doesn't make sense, right? I mean, they are, let's be honest, I'm not putting Tata down, but maybe they don't have the expertise in digital. I mean, I don't know much about that, so I can't comment. I'm just saying maybe that's the reason, right? It's not that, oh, because it's Tata, they're struggling. It could be very well people are recognizing that the model has to have legs to stand on.
Right. Sandeep, in your previous role at IFL Wealth and now with Deserve, you've had a ringside view of the public and private markets. And the sense was that, some of these new age IPOs, Zomato, Nykaa, Paytm, PB FinTech, it will finally prove that, investors in India get exits and it will lead to more dollars flowing into the country. But if you look at the year to date performance of these stocks, all of them are down by over 30%, 20%, 35%, and so on. So, again, how will that impact future tech IPOs? Because a bunch of companies had filed DRHPs from delivery to OYO, there was buzz on Ola, and so on. So, will we see this, impacting that as well?
So, Chandra, it's important to understand how public market companies get valued, right? You have a rate of discount, which is guided by the what is the Fed rate or what are the interest rates prevailing in the economy at that time. And some companies have cash flows today, some companies have cash flows later. The companies which have cash flows later get more impacted when the interest rates rise because then the discount, absolute factor of discount increases. I think when it comes to these kind of companies, the true thing is, as an investor, what's really your time horizon? If you have a very short time horizon, then obviously you're in trouble. But if you elongate time horizons, I still believe that potentially there is a long way to go for even listed tech companies in India. I mean, on one hand, you have Meituan in China, which is over $100 billion in valuation, and Zomato today is at $8 billion. Now, if Zomato makes that journey from 8 to 100, I don't know. It a lot depends on execution and various other things. But frankly, I think if you elongate the time period, there is a lot of long-term wealth that is going to be created in even in the Indian listed tech. Now, what potentially can happen is if the valuations are not up to mark for these kind of companies, some of the IPOs might get pushed and may internally get replaced by sort of pre-IPO deals, etc. This might be smaller and may not end up raising that kind of capital, but potentially capital will still be available to high quality companies. So I feel that as an investor, we should really look at the horizon. And if you elongate horizons, there are high quality businesses in India run by some of the best managements that we have seen. So I'm not as pessimistic on that side.
Right. Jitin and Madhukar, actually, this question is for both of you. Last year we had also seen how founders sort of held all the aces when it came to negotiating rights. They had, inserted various clauses that would give them veto powers on a bunch of things, from hiring to who they can have on the board to investors, etc. Do you think that will also change in the current environment? Perhaps Jitin can take it and Madhukar can add.
So, so I don't expect that to change. Honestly, in the case of founders who uh, who are focusing on their business in a fundamental way, and I think even if you look at last year, the founders who got their terms on the or raised capital on their terms, they were anyway solid in their business fundamentals. They own substantial part of their company if you sort of correlate the trend. So from that standpoint, if your business is good, if you own substantial say in your company, I think you can still get or raise capital at your own terms. So my view is a little extreme that I don't think so that's going to change.
So Jitin can still negotiate with Tiger Global on terms, even in 2022. That's the broad takeaway.
I'm not going
Quality
to.
companies, like we said, right?
That's why we said quality companies and quality founders
he
who
may
focus
he may
on
he may
value.
he may want to take the flip side now and say, okay, are they doing the right governance on my company? I honestly think, that this tide was on both sides. I mean, when you bring up the governance thing, I think investors need to start being a little more responsible as well. We can't just say founders and euphoria, right? Investors are just as responsible for what happened in Bharat Pay as anyone else. I could get into trouble for that. Shoot.
Yeah, over to Madhukar.
Yeah. Chandra,
Yeah.
I believe that uh, the agreements which are written and the terms which are uh, uh, incorporated in the agreements, right? They are at the end, they are reflective of the relationship of the founders and the investors, right? So what I have seen is that there are times when there are certain irrational founders who try to uh, put some of the terms which are not as per the market standard, right? Uh, and then investors have to agree, because at the end of the day they are also in the business of investing, right? And they can't let go of the deal, so they will agree to that at that point in time. And then businesses don't move in a linear direction, right? So they have their ups and downs, right? So those clauses which are negotiated by founders at their ups are renegotiated by the investors when they go down, right? And frankly, that's very painful for both the sides. So so I think those cycles keep coming, but that is applicable to a very small set of founders. Having said that, when companies become very large, some steps are needed to be taken from the founder side, because there are so many investors, and you don't know that how you can get hurt from one of them, which maybe joined very later and had taken a right which might hurt the company, right? So therefore, it becomes important, and that is well respected and appreciated. Uh, the other point which I want to make on the terms is that India now is a real very well mature in terms of terms and conditions, in terms of the agreements, right? So if you go back 10-12 years back, the kind of terms which investors used to give to entrepreneurs were very draconian, right? And from there we have moved on. There are no longer any double dips, right? So the drags, conditional drags, have just moved out of the picture. So there are a lot of terms which used to be there, which were really unfair to founders 10 years back. But in the last 10 years, the journey of the Indian ecosystem has been very, uh, it has seen a very strong growth, right? And that has brought all the good aspects, right? And we have learned from all across the world. So there have been value investors who have been investing, and they have been sharing their views. We saw for a few years the Chinese investors came in, and they were also investing, and we learned a lot from them as well, right? So I think we have a lot of global practices which are now available, and there will always be a few corner cases where some of these things will happen. But I don't I think I had a similar conversation with Sriram, I think 8 months back, and he was also asking about the same question. And I told at that time also that this only is a very corner case, right? Maybe applicable to very few percentage of the founders. Most of the founders are more busy in building the business, and the ones who are seeing real traction, they want to spend most of the times in building their team and executing on the ground, rather than trying to negotiate those agreements, which are anyways for doomsday scenario, right? And nobody is looking at those scenarios when they're investing.
Right. Tarana, do you also think 2022 will be a year? I mean, if you look at 2021, we saw, I think, 44 unicorns, over 30 million, $30 billion in, VC funding, which was again a record amount. But will 2022 be more about consolidation? We already saw that happening with, ShareChat and Takatak. So is there scope for more such things in other sectors as well?
But Madhukar should be answering that question, not me.
Yeah,
Since
Madhukar knows ShareChat the best, so maybe both of you
exactly.
can give us perspective.
I think we will see some consolidation, just because. personally, I think we will still continue seeing unicorns. Good companies will become unicorns. We will recognize that product market fit. But I think the reason we possibly will see consolidations is because there, as we know, right? I mean, there is going to be a little bit of a, let's call it a little bit of a cleansing in the market, and so folks may consolidate, versus, and there are businesses that make sense to sort of consolidate, right? Because they have synergies. So I personally think that we would see a few of those. And again, it's not a bad thing, honestly, because if there are synergies that they can leverage and build a stronger business, why not? So yes,
Madhukar?
I believe we might see a few more consolidations than we saw last year or in the euphoria.
Yeah, Madhukar, any sector that is ripe for consolidation? Because the internet has traditionally been a winner takes all market, but in India you have multiple players competing in literally every segment, and so far it seems to have worked for them. But do you again see scope for consolidation in certain sectors that perhaps has too many players?
Yeah, I think wherever there is a tech leverage, right, whereas if there is a strong tech leverage, I think we will see consolidations because uh, we have to understand that in case of short video content companies, their major costs are on the server cost and the marketing cost, right, which is basically creating the user base, right? And if you have multiple players, then you are kind of playing a zero sum game, right? You are increasing the CAC for yourself. So 5 6 years back, ShareChat has used to have a CAC which used to be like a few cents, right? And when I say a few cents, I mean that single digit cents, right? And in the next 5 years, when multiple players came in, especially TikTok came in, right? So the marketing cost went up through the roof, right? So we will see that some of the spaces where the tech leverage is very high. So if you have a very high user base, then you can negotiate on the cloud cost, right? And you have a very decent marketing cost because you're not competing with each other, right? So those spaces will definitely see a lot of consolidation. uh, the other spaces are also where I think consolidation should happen is financial services. Again, over there is a lot of tech leverage. At least the promise is that tech leverage will play out, right? So we'll see that few of the players will consolidate over there. Uh, I personally don't see much of a consolidation with for business reasons in companies which are largely ops driven, right? Or over there the consolidation will happen because of one company running out of the capital, right? And therefore that will be more like a distress kind of a consolidation. But these are the two spaces, at least the ones which I track. I don't track a SaaS or software as service a lot, so I don't know about that. But in the content and media spaces and in financial services, there is a good expectation of consolidation. And not only consolidation, you will see that some of the larger players will try to acquire also for because these companies have really become big now.
Right. Jitin, all this slowing down, rationality kicking in, will it also lead to rationality when it comes to salaries for tech talent? Because, that was the top theme last year, the war for tech talent and all kinds of crazy incentives, including BMW bikes, etc. But will this rationality in funding also lead to a rationality when it comes to hiring?
I really wish so, Chandra. So, but I'm not seeing yet that expectation reset on the talent side. So, I think it's a lag effect. So, uh, right now, like last year, most of the companies raised enough capital. So that effect is reflected in the salaries given to the tech and product guys, and I don't see this getting reset for next 6 to 12 months at least because of the lag effect. So if this year rationality in funding comes in, we will see the effect next year. But this year irrationality will continue in my view.
Right. Sandeep, a couple of questions for you. First, will we also see some parity when it comes to valuations in the private markets and the public markets? Because we saw a situation where, companies that were privately valued had even higher valuation than public markets. In fact, since Madhukar brought up SaaS, SaaS companies in the private sector were, valued at over 20 times forward revenue versus 12 times in the public market. So will we see that parity come in? And secondly, one segment that started investing a lot in startups were family businesses. Do you see that continuing, or will caution kick in? Because again, domestic capital was a big theme, and some of these family businesses were drivers of that. Will we see that continue?
Yeah, so on the question of parity, right, I think when a company gets listed, you're typically approached a stage of growth which is more stable, more steady. And with private companies, the bet is really that they will continue to grow at a much faster clip. So I think valuations will reflect growth rather than whether the company is private or public. If a company is continuing to grow well, it will get valued more than its peers in the same industry. On the other hand, if a company, even if it's private, is not growing as fast, then valuations will remain muted. As far as the question of family businesses and that kind of capital, I think there is a lot of interest. There is a lot of interest from Indian family offices to invest into tech businesses. We are seeing that there's actively seeking out opportunities. A lot of family businesses have set up tech investing teams within them. So I think that story will continue to my mind. I think they know that they are, especially when you reach a certain threshold of capital of north of 100 $150 million, you're now starting to allocate capital for the next 10 15 years, and the only go for that capital, the only place for that kind of capital, long term capital, to be deployed is private markets. So on that side, I don't see much changing. There will be increasing allocation. I think as of now, the quantum of capital that family offices have allocated to unlisted equity is still very low. So I think from an absolute percentage basis, that is only set to grow.
Interesting. We are winding down to the last 5 minutes. I'm going to end with a rapid fire of sorts, just three, four questions. So, Tarana, I'm going to begin with you. Is the Indian startup party coming to an end? Yes or no?
No. If I have to
Jiten?
go yes and no, no.
Jiten?
I'm an eternal optimist.
Clearly, no.
Okay. Madhukar?
No, no.
See, you didn't want to
Sandeep?
hear that,
You
did you?
say yes, Sandeep.
I
Rescue
would
this
have loved
person.
to say yes, but I will also go with the no answer.
Hey, you
Okay.
should be appreciating it. That, as the markets matured, we've evolved, that we all believe that, this
And
Okay.
is
Chandra,
a.
and
Okay.
Chandra, you should be worried. What would you write about?
We are busy writing about controversies these days, Jiten. So much more interesting than fundraising. But yeah, you valid point from you. Okay, so India produced 44 unicorns last year. Tarana, what do you think the count will be this year?
Between 35 and 45.
Jiten?
Yeah, at least half of last year.
Okay. Madhukar?
I think 50.
Wow, that's really optimistic.
Yeah, we
Sandeep?
are.
I would also go with 50 because I think there's a lot of companies at the edge right now, and they
The
will,
Sunicorns.
yeah, they
Yeah.
they will flip over.
Okay. Finally, Tarana, the hottest investment theme. What's that going to be?
Oh,
Quick
I
commerce.
had two fintech founders here. I think I need to say fintech to be in their good books. But I think I no, I genuinely, Jitendra knows this because he and I've had a bunch of conversations, and I think there's a lot in fintech that can be disrupted. So I'm still very, very. But if I had to say, I'd say fintech and B2B cross border.
Okay.
I think
B2B.
that's B2B.
Okay.
Let's put it as B2B for now. Let's leave it at B2B.
Okay. Jiten? Other than
Undoubtedly,
fintech.
undoubtedly fintech, Chandra.
Okay, any subsect of fintech apart from neo banking?
Neobanks. You know my answer. So no, so I think I would say that cross-border payments. I agree with
Yeah.
Tarana. That's the segment where I'm seeing immense opportunity, and
Huge.
there are at least 7 8 companies building in that space. And all are taking a very, very interesting route to get into that space. So that sector is going to be big.
Right, Madhukar?
Web3.
Oh wow! Oh, we are down
Yes,
to the
of
last
course.
question. I just realized I didn't say Web3 or crypto.
Yeah. So Web3, yeah. Web3 is going to be hot.
You've already started investing in a big way in this theme, Madhukar?
What,
No comment.
big way kaise hoga? Where will the big way come from? We are not a big fund, so we can't move the market. But yeah, we have started. We started investing.
But
Okay.
Web3, you mean there's so much in Web3? Crypto or NFTs or gaming? Or I'm asking Madhukar that question, or the DeFi
Not,
piece, blockchain?
not disclosed, but interested in all of them. Yeah.
Okay. Thanks, Tarana. Very good follow-up question from you.
Because
Um,
I've been trying to figure it out.
yeah, Sandeep, what's your hot theme for
So yeah,
2022?
obviously I would love to say well tech, but I think, and this is not a sector. Yeah, I think the theme of built from India for the world, I think, is a very exciting theme to my mind.
Okay, great. On that note, thank you all very much for joining us on this edition of Money Control Masterclass. Clearly, all our guests believe that the funding party, the startup party, is not coming to an end. There is just a pause, for rationality to kick in, but the party is, well, here to stay. Thank you very much for talking to us.
Thank you,
Thank
Thanks.
Chandra.
you.
Thanks to
Bye. Thanks
Chandra.
again,
Bye.
Chandra. Thank
Bye.
you. Bye.
Thank you.